Hello, everybody. Chris Martinson here, and today we're going to be talking about finance and economics as part of Finance U. Remember, anything that you see in this video and all resources available at our websites or affiliated websites are not intended as or construed as financial advice. This is for educational purposes. Remember, if you have a financial decision, please consult a financial professional. We are not attorneys, we're not CPAs, we are not financial managers. As well, we do our best to be accurate, and everything we represent is as accurate as we know it to be. Now, let's turn to our program.
But this is on a scale of the epic headaches, the epic hangovers that are going to occur, similar to what happened in 1929, similar to what happened in the year 2000. It was 14 years after, before the S&P got back to the same level it was in the year 2000. And that's with all of the intervention that the government put in there to try to turn the system around.
Hey, welcome to another episode of Finance University, everybody. Back with Paul Kiker, of course, of Kiker Wealth Management. Paul, we had a pretty interesting weekend, didn't we?
We did, Chris. The FLCCC conference was amazing, to say the least.
It was for me. For people who don't know, this is the frontline COVID critical care. Doctors Paul Merrick, Pierre Corey are sort of the heart of the doctor side of that. But now it's got all these other doctors, and they're busy working really hard to unravel the conjoined mysteries of long COVID and something that mimics that, which I can't say because it's going out on YouTube, the bastion of free speech in the world's #1 freest, fairest country, which of course you can understand how free and fair we are because there are people now openly calling for Tucker Carlson not to be allowed back in the country because he talked to somebody else. And that's, of course, not what you do in a free country.
I am completely shocked by what they're calling for. And apparently the EU came out today and said they wanted to put sanctions on Tucker Carlson because he spoke with Putin.
That's where we're at. So amazing conference for me because there was a lot of energy. They were sold out. And it's 560 people there. And the number of things that these doctors are figuring out, not just around COVID any longer, right? So if you can imagine, turns out there's been a little bit of subterfuge and shenanigans going on in almost every other major disease discipline. And they're busy unraveling all of this. So I would highly advise anybody who has questions about what we'll call a chronic disease condition, you really deserve to do your own research. No, go and trust the people who've done the research. And they've got all these protocols now at the flccc.net where you can pull down for things like type 2 diabetes, the big dreaded C word, not COVID, the other one, et cetera. So it's amazing. And they had some really astonishing success stories there. Really opened my eyes. So that's why I go to conferences like that, is to meet the amazing people doing some amazing things. It's something.
Yes. And I thoroughly enjoyed the conversations I had around the tables and the individuals that I met, and just, one doctor was explaining to me, he says, COVID really opened my eyes to what's taking place. And I started looking, and then I found the FLCCC group and other like-minded individuals, and just shared just how dramatic it had changed their practice and how much better they're able to help their patients, and just the discourse and discussion and truth, and not all this controlled propaganda that's pushed down through the top. It was really heartwarming to me. I was so excited about what I saw. I came home, talked to the two doctors that I talked with, and I said, I will sponsor you to go. I will buy your ticket and sponsor you to go if you'll just go, because it was that life-changing to me and brings that much hope to the future of our medical system.
It's likewise. I came out of there with a lot of hope because there are a lot of people who care. You know what? It really felt like a turning point where it's almost like we have traction now. We're gaining the upper hand. I lost count, 50, 100 people come up to me, saying how much my COVID coverage had meant to them, and that was just something I had to do at the time. I just had to, I get this bee in my bonnet that this is the right thing to do. And of course that got me in a lot of trouble, all kinds of things, broke up my partnership, because I just won't I can't not say what I believe to be true. I might not be right, but I will tell you what I think, and I'm just, this whole thing of we have to self-censor now, and, there's only an approved narrative that you have to stick to no matter how wrong it is, and no matter how wrong it is for your family, for your children, for your community, for the country. It's really, it's that part's dark, but the light part is seeing how many people, Paul, are like, yeah, no, we're not down with that. A lot of really, those are my peeps over there. Like, I like hanging out with the people who are open-minded and make up their own minds about things too.
Yes, and they care about the truth. And there's no doubt, your willingness to speak the truth and the courage and, and especially everything that happened on the other side, the impact that you've made in the lives of thousands of people is what we need more Americans to do. And,
Yeah.
those people there may not be as eloquent as you are and explain things as well as you do in an understandable manner for the average individual. But your inspiration and leadership, no doubt, because I had many people that came up to me and said, you were the one individual that caused them to wake up and look in the other direction, that are there. And just they were so excited about just how they're able to impact the lives of their patients more so and with more confidence, because now they've got an avenue to discover the truth.
Well, absolutely. And this is a medical conference, and so I took a moment to do a breakout session with you, which was about how to crash proof your portfolio, sort of one version of the title. But basically, I just said, hey, look, people, here's some data. And I had a bunch of people come up afterwards and go, that was depressing. I'm like, look, it's just data, right? And it's just, everybody's listening to this. And oh, by the way, that's freely available back at Peak Prosperity. So anybody watching this on YouTube, if you want to see that presentation, we did record it, and the questions and answers afterwards. So it was some macro data and some current economic data that kind of point to this idea that, okay, everything's not right with this. And I love the analogy you made to tie that back to our medical community. You said, what Chris showed you is just like a bunch of blood markers, right? And we just got the lab results back, and there's a lot of stuff that's out of range. So, maybe you would never ignore that with your patients. Probably we shouldn't ignore it here either. I thought that was a great way to bring them into the room.
Well, thank you. I've used blood work analogy under the markets because most people can understand that. They can't understand breadth and participation rates and silver cross ratios and all of this, but they can understand blood work. And especially, what was amazing to me, and I shared it with you and maybe in that talk as well. I can't remember exactly where I said it so many times, but in the first day to kick off the conference, when they were sharing just how much corruption has worked its way into the system and presenting the evidence for that in the healthcare industry, I was thinking, all I have to do is replace financial services industry for the word healthcare, and I could say nearly exactly the same thing.
Mm-hmm. Speaking of which, I want to. Can I talk about this? Can I got a slide here I want to talk about. It's a miracle, baby. Ready?
Yes.
It's Sven Henrik saying, if this market was rigged, there would be no red candle. One red candle. Like, I believe that if we close out green today, which we probably will, this will represent the only time in all of history that we've gone 15 green with one red in that mix.
Yeah, I believe that is correct. It will be, and it wouldn't surprise me. And I'll tell you, Sven Henrik, the Northman trader, does such a wonderful job of just pointing out in a very wisecrack manner that people can understand. His work is really good. It really is.
So getting back to this, I know we've talked about it before, but for anybody who maybe hasn't seen those episodes, I do believe in what we'll call manipulation, in the sense that I know that are on or about October 30th, things were of last year, 2023, things were really starting to fall off. The stocks had gone through a critical support level and started to look like game on, and then magically out of nowhere, we've been treated to this instead. And my explanation for that, after watching these things for so many years now, is that the stock market is no longer a discounting machine. It's a liquidity measure. And all we can tell you is that, all I can tell you is that with all that green, somebody got scared and somebody dumped a bunch of liquidity or eased financial conditions, or whatever your language is, into the markets, which need air quotes now, double set. And that's what we're up to, because things just don't make sense. But I'm sure you've seen it. I didn't pull a picture up, but the stock chart of Nvidia, somebody, bless their hearts, said, "Oh, what could go wrong?" And they put up a chart of tulip bubble mania and and so the internet craze, right? And they're identical charts. It's like a skyrocket with a little retracement and then a big giant, final blow off, right? But these feel like dangerous times to me. And again, to Sven's point, he made a second comment under that other one. He said, "Old markets, broad market selling and volatility spike on banks blowing up for fear of contagion. New markets, buy everything for record highs and crush the VIX on banks blowing up for fear of missing out on the next round of interventions."
So eloquently spoken.
New hotness. Let's talk about the new markets today, shall we, Paul? What's going on?
Well, going back to that October low, what was interesting, and this is something that I had seen really occur going back to 2014, 15, 16 when I really started recognizing it, because it was a slow change under the surface. But there are a lot of institutions, there are a lot of risk managed portfolios out there that use what we call decision points, lines in the sand where the market breaks a certain level. And, think, for example, you've got a floor above you, the second floor of a house that's got a weak floor. It's 15 feet from that second floor down to the bottom floor where you're standing. Well, if somebody jumps up and down enough on a weak floor, at some point that floor is going to give way. And those are decision points because, back in October, NASDAQ closed below a couple of important levels, and it stayed below it for the third day, and there was an air pocket down below that to the next level of support. So it gave us a good indication, yes, the market was oversold, we should get a bounce, but the reality is that gives us an indication of the downside risk at that level. And then out of the blue, the Fed comes out with this complete 180 and says, instead of higher for longer, now we're going to cut rates. Well, what that did was fuel a repositioning in a lot of those portfolios and kick this momentum into the market. And now it's taken on a life of its own because you've got program trading and gamma squeezes, things that we should never have to talk about. We should never have to talk about a gamma squeeze. Quite frankly, I don't even think I I never even had to figure out what a gamma squeeze was till back 2014, 15, 16, somewhere around there, much less try to explain it to a client at this point. But it takes on a life of its own, but it created the backdrop with the jobs numbers, looking a lot better because Wall Street doesn't care necessarily about the revised numbers. They pay attention to the headline numbers. By the time the revised numbers comes out, that was yesterday's news. They're focused on something else. So it has created an unbelievable amount of momentum, which has pushed us to new highs. And if we close this month, the month of February, at a new high, then that's going to be a breakout of a 3-year resistance on a yearly candle, which is probably going to add more repositioning of portfolios and carry this momentum a little bit further. So there's a lot of concerning things that are taking place under the surface of the market. Going back to that blood work analogy, when you've only got the generals on the battlefield or you've got a few markers in your blood work that look good, think Magnificent 7 or maybe Magnificent 6 now since Tesla's starting to struggle a little bit. That's a very concerning undercurrent. But this momentum, if it continues, because there's continuous narratives coming out, new narratives, hey, Trump's going to win the election, he's going to fix everything, so buy every dip. You've got a major firm that came out and said that this week. So, we could very well be creating the greatest bubble in history with this momentum here if something doesn't derail it here in the short run. And it's hard to imagine that something's going to derail it here in the short run.
Oh, yeah, I know. Speaking of which, I don't know. Maybe Trump has a run for his money because Nikki Haley polled pretty well. They had a primary vote in I think it was Nevada. Okay. She got 20% of the vote, 20%, and Trump wasn't even on the ballot. So 60% of the vote went to nobody on the ballot. They actually had a none of the above vote.
No
60%
way.
to 20. Yeah, she lost 20 to 60 to nobody. So I just. Oh, yeah, I could do without one more, cookie cutter neocon, warmonger, draining the blood of our country for no reason. That's fine by me. So, leaving politics aside, though, here we are. I think to Sven's point, though, this it wasn't just the banks that are highly volatile right now. There's all kinds of volatility poking around here. Wait a minute. Like, I'm so old, I remember when headlines like this used to drive stuff, right? So you've got this, border crisis going on with rank and file sort of, rebellion going on. But look at this next one. Medvedev warns, that's the president of Russia, warns that Russia has no choice but to unleash nuclear apocalypse if attacked by NATO. The end of everything. Like, I'm so old, I remember when a headline like that might have caused a little consternation, not one more green candle, And so this just goes to show our markets are highly disconnected. But to your point, listen, maybe what they used to do or should do doesn't matter. We have to go with this is what is happening right now.
Yes.
And
so, and that's the challenge in the asset management standpoint. We're constantly having to make a few adaptations. When you have a basic structure in place that helps you make decisions, you don't have to rewrite the whole program, but you do have to make adaptations to the environment that we're in. And I'm not saying that you make adaptations that it is different this time, okay? Because that's the most dangerous thing that you can say on Wall Street is it is different this time. But there are a lot of undercurrents in the market and behavior that is the same that it has been historically. It's not uncommon for these euphorias to take place. History is littered with the euphorias and the destruction on the other side. So, but you don't know how long they're going to last. We don't know how long they're going to continue to kick the can down the road. I think it was Peter Boghossian, if I remember correctly, at the FLCCC conference, expressed his concern with the national debt level, and made the comment, I don't even know if we can pay this back, right? So somebody not in the financial markets per se are asking questions like this. But the question is how far does this continue? How much momentum can it carry forward? But the reality is when it blows up, you have to have your exit point. That's great if you own NVIDIA, but it doesn't do you any good if NVIDIA was to collapse like Amazon and many of the internet stocks did back in the late 1990s. The reality is they changed the future of the economy, but investors were so excited about what they could see in that change in the late 1990s. Once the euphoria left, a lot of those stocks cratered 50 to 80% and didn't see those levels again for 12, 13 years. Even Pfizer still, I think it took them 19, 20 years to get back to the Viagra euphoria that they had at the end of the late 1990s. So,
one thing, on that point, Peter Boghossian was worried about $34 trillion in debt. And the fact that we had a $1.6 trillion deficit officially, unofficially, when you look at their debt, as we pointed out in that presentation, when you actually ask how much new debt did they take on, they took on 2.7. Okay. We'll get back to that point in a second. But how about this? This just came out today. The CBO has said, by 2034, we're projecting a $2.6 trillion annual deficit. And this is the CBO, that's the Congressional Budget Office. So, of course, this is just a forecast based on current law that's on the books.
That's insane. I've not seen that headline yet.
Yeah, it just came out on CNBC this morning. So, this morning, people watching this, this is Wednesday when we're recording this. So what?
My question is, what kids laugh or cry? That's about all you can do. If that's our personal budget, let's imagine that as an individual. That's our credit card statement, and it continues to grow at that level. At what points, are you going to hit that limit where the bank's not going to loan you any more money, or the credit card company's not going to loan you anymore because they know you're not going to be able to pay that back? And nobody seems to be concerned about the level of spending at this point.
Well, I know you are, and that's what you do with your clients. And so for anybody, you have to have a plan, obviously. You just can't look at this and say, oh, shrug, I guess we'll just deal with that when we get there. No, that's 1.6 trillion this year, 1.7, like literally that just sneaks up the whole time. It's not like suddenly 2.6. We're running $2 trillion deficits as far as the eye can see, and that's without a recession or anything bad happening, and that's without some knucklehead getting us into some sort of war with China or any of that other stuff or in the Middle East, right? This is just straight up what's on the books, and this is ruinous. So my mission at Peak Prosperity is I want to leave behind a world worth inheriting. This looks bad. You know how bad this is? You want to know how bad this is? That I don't know if you saw this, but Jay Powell was just being interviewed on national, well, was it CBS? I forget. But he was just
60
interviewed
minutes.
in 60 minutes, yeah. And so he was asked a question like, oh, I've heard you say that this is unsustainable. What do you mean? And he said, well, of course, obviously when your debts grow faster than your income, GDP, that's by definition unsustainable. So he repeated that. But then he went all Thomas Jefferson on everybody and said, and by the way, it feels immoral. I'm paraphrasing. For one generation to spend wildly and saddle the next generations with that debt. It's kind of incumbent on each generation to pay its own way. The people who are behind this, totally irresponsible people who, would literally burn their furniture to stay warm. Damn the kids, right? I have a very strong opinion about this. It's wrong.
It's wrong. And really, we've mentioned this before. It goes back to the weak men, weak individuals create hard times, and hard times create good people. Well, a weak man per se, just weak individual, doesn't have the discipline to control their restraint, right? They can't behave themselves. They can't make decisions in the short run, sacrifices in the short run for better gratification down the road. So we have a whole generation right now that seems to be silent at this point, that is refusing to stand up and hold their leaders accountable. And that's the reason why these weak men that are leaders, men and women that are leaders, are more concerned about their image in the short run than the damage that they're creating in the long term. And it's terrifying. I mean, to pass that down to the next generation, that's not passing wealth down. Wealth is not passing debt, right? If you pass debt down to the next generation, you're making it harder on them. If you're passing wealth down, that means you've got assets that are free and clear. You've got assets that can produce income. You've got manufacturing and good roads, and spend money taking care of what's taking place here at home.
Yep.
And I just don't see how they can't see that.
Yeah.
Don't understand.
Well, I don't either. And it was the best part about being at this meeting with you was just watching you interact with people, right? Because you're Paul Kiker, you're genuine, you really want to help. People understood that. I just watched your interactions, and I feel really good about that because you're coming from a place you're honestly trying to help. I want to help people. I think you have to understand what's happening before you can make a decent sort of decision about that, even though that might be a decision with imperfect information. You do the best you can, right? And so I think that's it's just really important. So for anybody who thinks they would love to work with Paul, and you all do, you would go to peakfinancialinvesting.com, fill out a simple form. Paul, you or your firm will contact them and get the ball started. And I know you're actually quite busy these days. So
we are. That's a good thing. So, and thank you for that, Chris, because that's one thing that I always hope. When I say my prayer, I'm like, okay, Lord, grant me the wisdom to say what needs to be said. Grant me the wisdom to help these individuals that are here and make a difference in their lives, and help them and their families to be in a better position. So, it was interesting because at one point when I had one individual that had a realization of kind of what we're facing, and just emotion just absolutely covered him up. And I didn't have time to talk to him because we had so many people around at the time. I'm like, hey, find me later. This is where I'm sitting. Find me. And we were able to sit down for a little bit and kind of settle that down and say, look, there is opportunity in the midst of this. Our margin for error, and the reality is our margin for error is a lot smaller than what it's ever been in the past. You make a mistake in this type of environment, if you're not managing your assets correctly, you don't have exits. When this market does come apart, you can do irreparable damage to your finances. But if you're courageous enough to face the truth, and you go through and take the time to develop a plan and consider alternatives and plan A, B, C, if this happens, then you're 2 steps ahead of the average person, and the future's bright. The future will be bright, and sometimes it gets darkest before it gets the brightest, but having the wisdom and the courage to take the time to sit down and look at it with truthful eyes, and seeking the truth and looking for wisdom, it can be navigated. It can. And that's our role. That's our role, is to talk to people. And every now and then I do get a little bit of pushback, because the first thing that I do is I take somebody through a full retirement plan analysis. And every now and then somebody will say, hey, let's just talk about the asset management. And I'm like, the asset management's really the easy part, because unless you know where you are on track to your retirement plans, and even if you know that you're on track, I've not found an individual that we've not been able to add some value to yet by going through that process, and they're better armed, they're better prepared, they know why they're doing what they're doing, and then you bring the pieces of the strategies together to help fill in those gaps or make sure that their plan can be implemented with adaptation along the way.
Yep. Well, let's just talk about this, and thank you for that. It's so important. So the weak men do create hard times. And of course, for the unprepared, that can be a real bad moment. Now, if you are prepared, I think it does also create opportunities. And I'm not trying to say, oh, let's get greedy. Here's the great stuff. But if you understand the context, let me show you what I mean by this. Let me think here. Okay. So let me start with this. You probably heard that somebody blew up the Nord Stream pipelines, right?
Yes.
And then the U.S. went to Europe and said, don't you worry, we'll ship you all the LNG, liquefied natural gas, you need. So then U.S. drillers go out and say, okay, well, now we have to supply the U.S. and a big chunk of Europe. So they start creating a lot of natural gas supply. And then, whoops, rug pull, the Biden administration comes out and also, after the Nord Stream incident, says, oh, for environmental reasons, for climate change, we're not going to authorize these new LNG terminals where it can be liquefied and sent over. So, hey, sorry, Europe, were you relying on us? That's that scene in Animal House where he puts his arm around Flubber and says, yeah, you effed up. You trusted us, Remember that?
That's a good picture.
So because of that, let me just show you how this comes together then. So this is number 4. Let me see. This is the price of natural gas. Just broke below $2 per therm, right? And it's just been, it's way down there. So it's below $2. And this is not investment advice, and I have no particular positions, and this is purely for education. And I haven't even assessed if all of this is true, but I do trust this person, generally speaking, over on Twitter. The king of fracking, the WTI realist, said, hey, look at the names of all these different, natural gas producers down here, right? And say, what is their free cash flow at $2 at Henry Hub? That's what HH means. That's $2 per therm. Their free cash flow is 0. So if they're getting 0, now they're a little bit below 0, right? You know what happens next? They don't drill. And when they don't drill, in the future, we end up with this stuff called a supply shortfall. And when that happens, prices spike and the economy goes through all it's terrible that we're here, but that's a very weak decision. Team Biden did this because they thought it conferred some sort of advantage to them, or, out of politics, or who knows what they're doing, but it's a very inconsistent, weak set of decisions that's going to create a cheap gas now and much more expensive gas later. Now, if you know that, obviously you can begin to, think about how you would position for that. But
yes,
this whole idea of playing politics with big, giant, important markets like energy, terrible idea, really bad, weak. Not good.
Yeah, not a recommendation, and we're not entering it at this moment in time. But as soon as that breakdown occurred, I had an alert that comes up on my watch list, so I'm looking at it on a regular basis. But one of the things I don't understand is you have an opportunity. I had heard, and I can't remember this specifically, but they had made that decision because there were some climate activists that had kind of raised some cane about it, so they decided to change, for political purposes. But isn't there a national, Chris, I'll ask you this question. Isn't there a national security risk if these companies are unable to stay in business and they go under, right?
Huge.
It takes, maybe I don't know enough about natural gas to know how quickly they can come back online. But if we had some major national emergency and you had to utilize those resources and you gutted these companies for political purposes in the short run, that's a risk. And that concerns me when you've got the petroleum reserves that have been drawn down as much as they have. It's like we're maxing out our credit card as a nation, and then we're liquidating our emergency funds as a nation. If you consider strategic petroleum reserves and natural gas production and infrastructure, we're neglecting our savings. Who's going to bail us out as a country, right? I mean, it's not like, it reminds me of a overly spoiled child that's not going to have any emergency funds whatsoever and run their credit card up just hoping mom and dad's going to continue to pay for things. And that's the way maybe that's the way they were raised. That's who's in control now, and that's the way they're running the country. But that's the only analogy that only similar situation that I can bring to mind, because it just doesn't make sense. There's nothing wise about these decisions at all.
No. And Biden, by the way, his administration, it's not really Biden. I blame him a lot because it's an easy word to say, Biden. But we all know that he hasn't actually been in charge of anything for quite a while. So whoever's setting that policy, clearly they're ideologues, and it's about the narrative. And so this administration and its handlers have been the first in my adult lifetime that has chosen to use the SPR to help day trade gas prices lower for political ends, right?
Right.
Like for the equivalent of they're literally selling grandpa's coin collection for beer money at face value. I mean, it's awful,
Yeah.
So
it'll take the country, unless we get the Goldilocks scenario and everything works out perfectly like it does in the movies, right?
Yep.
Then there's a lot of pain on the other side of this, and it'll take a long time to recover.
It will. So let's again. So this is what Ed Dowd says. He calls this alpha. So in market speak, right? And you know more about this than I do. But beta is sort of your general exposure to markets going up and down. So if the market goes up 10%, the beta says your stocks will also go up 10%. It's just due to market conditions. But alpha is the unique knowledge that would drive any particular stock or share up or down against that, right? So the alpha is really important. And Ed makes this great point. He said, Wall Street really doesn't understand what just happened, from a healthcare standpoint. And that's all I can say because it's going up on YouTube. But I want to talk about this real quick. This is legit alpha here. So what we have here is a tweet from Ray Armat saying the disastrous and costly approach to COVID and general healthcare. Humana's shares plunge after its earnings are expected to be about half analysts' expectations because for some unknown and baffling reasons, more people were admitted for hospital stays than it expected late last year. And no, it wasn't tied to respiratory seasonal illnesses. Something, and we just had a whole weekend of talking about what this something might be, but they're baffled. They're baffled. Like why are people in the hospital? Like, oh, if any of them came to this conference and they heard the stories you and I heard, that's one of the things. Like, this was really powerful, and for anybody who wasn't able to go there, the FLCCC offers a pro package. You can buy access to the seminar afterwards. I would do that just for the case studies. 46-year-old woman presents with did this, didn't work, did this, started to work, did that. But when you heard like case after case after case after case, it's really clear. You can begin to understand what was happening with this chart right here.
Yes, and real world evidence. And what amazes me is how did Wall Street get caught off guard by that, right? But I mean, I guess the majority of the people are drinking the Kool-Aid. They didn't attend the FLCCC conference.
Well, it's the importance of, like, if you're running a false narrative, it'll cost you, right? So if this time is different are dangerous words, so are, like, what? Well, let me paraphrase. I guess must have been Mark Twain who said, it ain't what you know for sure. It ain't what you don't know that hurts you. It's what you know for sure that just ain't so.
That's right.
Was that it? Yeah.
That's right.
So these people all understood safe and effective, and turned out not to be the case, they couldn't see it because the narrative structure is so powerful. So that's really, the mystery is, like, you have such a hard job because you have to be able to see what's actually happening, not what you think is happening, and that's where you got to be nimble, I guess.
Yes. And I wanted to go back to about the pro access for the FLCCC conference.
Yeah.
So I must have been in conversation and outside because I went in at a pro level just trying to support the organization. So I can log in and see all of the videos and case studies and everything that's there.
As soon as they're produced, right? So they have like X hours of material, and they're going to have to like chop them all up, and there's video production. So I think that should be done soon.
Okay.
Would be
So
my guess.
So if that's the case, one thing I will encourage every listener that's out there is if you have any interest, if you can get that, go like Chris said, and be a pro subscriber. You're supporting an unbelievably truthful and hungry for the truth organization
Mm-hmm.
that is, could potentially be setting up an alternative path that is the way to the future going forward if the existing system can't be fixed. But
Mm-hmm.
at a minimum, driving that. So I would encourage everybody to go in there and look at it. At a minimum, just support the organization because they're doing things that are going to make this country better and the health of ourselves, our kids, and our grandkids better.
Yeah, yeah. And in fact, they're already taking over things that should be done by the FDA, the CDC, and the AMA. Not all of their functions, but things they should be doing that they can do. They're picking them up. I mean, it's just what a colossal failure, but by our institutions. But similarly, I think we had a colossal failure by the Federal Reserve, right? Which got a little activist, interventionist, and a little more, and a little more, and next thing you know, they're like having to intervene every time the stock market even threatens to wiggle down, and all of that's fine. Except that, what's the exit plan? Like, how do you but not just the Federal Reserve. Like, how does Japan get out of its debt trap that it's in? It has a declining population. The central bank just keeps buying and creating more and more and more debt, so debt per capita is just skyrocketing, right? Much faster than you would expect from either of those two curves alone because they combine. And like what? It just does that forever? You know? Like eventually people in Japan owe infinity when they are born? It doesn't make any sense whatsoever. And of course it doesn't. But here we are.
No, no, it doesn't. Well, I was reading an interesting article a couple of days ago. I can't think of the name of it, but I do remember one specific, potential trouble that could happen in the future. So imagine, they're starting to have a little inflationary pressures in Japan. They're talking about, raising interest rates a little bit, leaving that zero bound, not very much. But what happens if our fiscal irresponsibility in the United States starts putting downward pressure on our credit quality, and you've got inflation that starts to run hotter than what anybody's anticipating, and there's an alternative for all of that Japanese money to leave the U.S. markets and go back to Japan, right? We've shown charts before where the U.S. has been the only game in town from major indexes that's positive since January 1st, 2008. That's a sea change in capital flows that would make it much harder in the U.S. And especially with the backdrop we have right now, back to the 60 Minutes interview with Jay Powell, one thing that I picked up on there, just to kind of set the stage, Grant Williams in his most recent commercial break monthly newsletter stated that around 44% of office properties have negative loan to value. So in other words, they've got negative equity, right? So if these loans would have to be called or money's going to have to be put back in there to shore those up a little bit.
Now hold on.
That's
a huge statement.
Yes.
because I'm unfamiliar with any commercial loans that don't at a minimum have a 30% equity stake to begin, but sometimes as high as 50%. So that means just if these things had a 50% equity stake, that 50% loan is now exceeding the probable value of that
Yes.
property. That means that these things have fallen somewhere between 30 and 50% in price since that loan got originated.
Yes. And
Ouch.
he goes on to explain all of these major properties, and I can't pull the numbers up in my head right now, but this may be a horrible example, but this just gives you an idea of the magnitude. A $400 million property that closed 2 or 3 years ago sells for $70 million, something like that.
Mm-hmm.
So I may be off on the numbers, so don't take that specifically, but it gives you an example. The numbers were shocking to me. And then he goes on to state that 44% approximately had negative loan to value. That's a pretty big deal, and that's cooking under the surface. Well, the IMF comes out. If you can, my assumption, I hate to be so cynical, but my assumption would be that they've gamed the numbers to make it look as possible. But they're saying that commercial real estate prices have fallen 11% since the Fed started raising prices. But what we're seeing is New York Community Bank starts collapsing in its price. There's some issues taking place right there at this time.
This
You
this
had that
little
there.
place.
Yes.
Oh, by the way, the pro tip, everyone: if this is your bank, consider your options very carefully. What you right? Zero Hedge just said that they were
Yeah.
very careful in a press release. They said, oh, they hadn't noted any particular outflows from their retail branches, which is weasel wording because, like, what? You expected people to go down with a duffel bag and, like, say, fill me up, right, with cash? Most people are going to move their money online. So, anyway, but this is, by the way, when you see a 55% decline, run, don't walk. That's my educational comment of the day. If that's your
Well,
bank.
why is it worth taking the risk to be over the FDIC insurance coverages, right?
Never.
I mean, I was completely against the government just stepping in and completely bailing out all accounts in the Silicon Valley Bank failure. But at the same time, I had a local restaurant that did their payroll through there, and they would have lost their whole payroll. It was tied up for a short period of time. So maybe that's the reason they stepped in. And I guess we'll find out in this case if they're going to bail everybody out. But it's not worth taking the risk because at some point, they have the power to take it away from you. Why would you take that risk in any way whatsoever, especially when treasuries are paying so good, and you can go directly to Treasury Direct, or you can do a Treasury money market through your broker dealer. But I thought what was interesting, because under the surface, I'm starting to see some headlines that how the commercial real estate crisis is going to be terrible for small banks and it's going to be great for the big banks. And the big banks are actually really positioned well compared to the regional banks to weather the storm. But on 60 Minutes on Sunday, Jay Powell said, quote, "There will certainly be some banks that have to be closed or merged out of existence because of," my wording, "the issues." Back to his quote, that the smaller banks, I suspect for the most part, these are losses. It's a secular change in the use of downtown real estate. And the result will be losses for the owners and for the lenders, but it should be manageable. Bottom line, we're going to see a consolidation more than likely in the banking industry, and it's going to benefit the too big to fails just like it did in the 2008 crisis.
Actually, all I didn't hear a word you said except for should be manageable.
Yeah, we've heard that before, haven't we?
Should be manageable. Wink, wink. Plan accordingly, folks. Right?
Yeah.
But no, no.
Yes.
We've been here before. Obviously, people think of the Federal Reserve as a sort of infallible oracle, and of course they just make blunder after blunder after blunder, and that's why we're here today, even at all, in this particular situation with unpayable debts and all this and that. And I know the Federal Reserve like to say, oh, that's a fiscal thing, those debts, right? But it's enabled by the central bank, right? So nobody markets would not have taken interest rates to zero and held them there. The market would never do that, because that's telling us that saved money has no value. And of course, that's stupid, right? Of course, saved money has value, and that would be expressed as a rate of interest. So the Federal Reserve, in its infinite wisdom, decided, zero. Well, let's make it zero for year after year. What could go wrong? These banks that are blowing up. So it's funny to hear Jay Powell say, well, of course, some banks will have to close. Now, these are lost jobs, lost lives. Equity holders get it in the shorts. They were forced not to make bad real estate loans, but they were forced to take their excess reserves, such as they were, and put them in treasuries, which were paying stupid rates like 0.5% on a 10-year. And then when the Fed raises rates, it makes the value of those bonds go down, and now they don't have the capital that they used to have. This isn't an accident. It's not like, they chose poorly. It's like they had no choice. So the Fed creates the conditions and then says, some of them are going to have to go out of business. And then, surprise, all those assets get vacuumed up by the big banks, which aren't exposed to those same pressures. And next thing you know, you wake up in a country with just 4 big banks, and that's the end of that. And to act like it's a mysterious process of nature is what offends me, because it's an act of policy, and we should just say it. Hey, Federal Reserve's going to drive regional banks out of business so that the big banks can get bigger.
That's right. And the regional banks can't compete on the level that the larger banks do. So what was left for them, right? I mean, that, residential housing, which they've been burned from that in the past, they're participating in that to an extent. But, they hold these big commercial loans in-house in those regional areas where they know that's a market niche that they had the opportunity to move into and be profitable. And then, 0% interest rates incentivized foolish consumption of debt. And then all of a sudden things change and it's gotcha, right? It's gotcha.
Mm-hmm. Yeah.
And it gets consolidated up. So, yeah, it was incentivized. You didn't know when it was going to end, but you could clearly see where it was going, that at some point, those debts are going to be too burdensome, especially with interest rates going higher, and then the game's over.
Yep. Well, so again, there's sort of institutional failures with the FDA, the CDC, et cetera, NIH. But same thing for the Federal Reserve, right? At some point, I think they went off mission, right? They forgot. The CDC forgot it's actually about public health, not private profits, right? Or whatever their story is, right? But the Federal Reserve forgot that it's here to serve the country, right? And they have this song and dance, right? They're here for price stability and full employment, right? But they don't care. They're really here to make sure that the banking system is safe and sound. And unfortunately, they've gotten themselves locked in a dynamic where that just means more and more and more money just handed to the banking system. And so I put up one chart at that FLCCC breakout session, which just basically said, look, excess reserves or reserves held back at the Federal Reserve branches right now is about $3.5 trillion. And they're paying 5.4% on that, which is $162 billion of interest payments back to the big banks. But if you followed this story, it was the Federal Reserve printed money, gave it to the banks put it back at the Fed, and the Fed's now paying interest on it. What? Right? $162 billion. I mean, let's put this in context. Paul, what other industries have earnings even remotely close to that? And they're getting it for free. Nothing happened. Yeah. No loans were made. No houses were built. Nobody went to school. No vegetables got grown. Nothing happened. But the Fed basically printed $162 billion out of thin air and handed it to banks because the banks put the money that the Fed just printed back with them. I mean, if you get it, like, and then then the Fed comes out and goes, yeah, it's really terrible how middle class is being crushed by inflation. We're mystified. I have to laugh about it again. I'm not laughing at anybody's misery. I'm laughing because it's just absurd. It's absurd. It's absurd that we have to pretend like that's a reasonable thing for somebody to say.
It really is. It's laugh or cry, and laughing is a little bit more joyful.
Yeah.
In the midst of the pain. So,
yep.
Yeah, it's frustrating, and especially when you look at the rates that they're charging that risk free, the American citizens are on the hook for it. But yet that same American citizen goes into that local bank and they're going to get a CD that's 3% lower than what they're going to be charged for any business development or construction and it doesn't matter if you're making the payments anymore, right? There was a time where as long as you were making the payments on a loan that you had, regardless if it was upside down, that you could continue to stretch that out. That is not the way it works anymore.
Yep.
Doesn't matter if you're in a position to make the payments. If the asset prices drop below, they're not going to renew that loan without you putting a substantial amount down, which forces the foreclosure on that to somebody else's benefit.
Yep. Well, have we been here before? Have we seen crazy market action like this before?
Absolutely. So we've seen it in two different environments. Late 1990s. It was this is different this time. I mean, I think I'd talked before, I clearly remember. I can't find the video, and I found out that most of their videos are copyrighted, so you can't, they're not out there. But I remember Jim Cramer just talking about how Warren Buffett was too old to manage in the late 1990s, and he didn't get it. It was the new economy, and things were different. And, of course, in his eloquence, he comes out and says, I don't buy things I don't understand, which was a much simpler way of saying I don't buy things that have no cash flow. So the technology bubble, was no different than this. And from the Enron chasing to the, there were NVIDIA type stocks that were taking place back then. I remember GE was the number one performing stock in the Dow Jones Industrial Average from inception to the year 2000. And of course that stock's well below what it was back in the year 2000. So when things look the greatest, it's usually when the most danger is out there. So that bubble burst. But we had a stock market bubble in 2007, but I didn't see that much euphoria taking place in the stock market. The euphoria back then was in residential real estate. Mm-hmm. And, people were making, chasing and fear of missing out. Right now, I'm seeing a little bit of both. It's like a bubbles everywhere, and you don't know when this ends. But we can identify that we're at that stage in the process psychologically, which we have been through time and time again throughout history. But this is on a scale of the epic headaches, the epic hangovers that are going to occur, similar to what happened in 1929, similar to what happened in the year 2000. It was 14 years after, before the S&P got back to the same level it was in the year 2000. And that's with all of the intervention that the government put in there to try to turn the system around. So yeah, we've seen this before. There's no doubt that this is a euphoria. You just don't know when it ends and how much higher it goes. But this is the point of greatest risk.
I agree, and I can't, Paul, I can't chart a path to prosperity looking just at these numbers alone, right? So if we just took them at face value, we average it out, that's 10 more years. That's another $20 trillion of debt minimum, right? On top of 34. So we're at over $50 trillion of debt, right? How do we pay that back? Where does that come from, right? How do we get through that without that, taking our overall prosperity and dinging it? We all know in our heart of hearts, that means the Federal Reserve is going to print, and they're going to print more. And when they do that, that's going to, of course, create inflation, and that's, of course, going to hurt the people who can afford it the least. And at the same time, we're bringing in, I don't know how many millions or tens of millions of migrants to sort of water this whole thing down. It's just a powder keg. And so it's against that backdrop of what I'll call, at best, defective leadership, right?
Yeah.
That people have to prepare. They've got to get ready for this and do the best they can to understand it, position as best they can, and be nimble, because everything's going to change as we go through this, right? But the sweep of the story is pretty well locked in. It feels like to me. I don't know how you feel about it, but
it is.
I can't see a path to resolution yet.
No, and that was a 62% increase in those numbers. I mean, that's parabolic. So, and you've got to consider the three paths, and I'll come back to what concerns me the most for your average American. Okay. So if you're sophisticated enough and you're on Wall Street, you're either oblivious to it or you know what's happening. And you're playing the rules playing the game by the rules that are forced upon you. Okay, it's kind of the way we operate. We've got some tools that can help us find the exit. They're not perfect. There's nothing that's going to navigate this perfectly, but it'll help you navigate it good enough to have a shot at being successful over the long term. But if you're the average American, you don't understand what's taking place. You probably haven't since about 2015-16. Okay. So you don't want to play the game in the market, so you've parked it in a 0% treasury or a CD or something like that back at that period of time. So here we are now in 2024. You've been through the COVID volatility. You're like, for a moment, you're like, thank goodness I'm in cash. And then the government prints and it bails it out, and then the markets take off and they keep intervening. At some point, these people aren't going to be able to take it anymore. Right? It's like, I just gotta get in, right? Inflation's leaving me behind. My brother-in-law's making 10 times more than I am, and I'm tired of his bragging. And, so they bail in, usually at the worst time, right? And maybe they get 6 months of instant gratification. Maybe they get 12 months. But then we have a 50% market decline. Okay, so we stumble. And like you point out back in 2008, time and time again, we had a little blip downturn in that credit expansion, and then it nearly took the whole system down, right?
Yep.
So what's this individual going to do at that point? They missed all this. Now they're down. It's going to be nearly emotionally impossible for them to stay in there. And more than likely, what's going to happen is they're going to go back into that position that they were in, regret they've ever played that game, because the rules keep changing on them. And then the government comes out and prints us into oblivion, and inflation takes off, right? And now they're a deer in the headlights. That's the people we're trying to help. We're trying to help make sure that they don't end up in that situation, because, we might play this game and maybe they kick the can down the road another 24 months. Maybe this momentum carries 12 months. I don't know, but we have signs and like blood work that can kind of give us an indication that risk is high, and then you dial that risk back so that you're not in that situation, right? Not that we're going to remove volatility. Volatility can be your friend when you have the backdrop for the market to go up, because it'll go 5 steps forward, 2 or 3 steps back. Well, it used to. Now it's just 20 steps forward and then 1 step back, right? Or 20 steps forward and 40 steps back, So that's what our job to do is to work with individuals, help them develop a plan, know where they need to be, how much risk they need to carry to be successful, so that it's not a questionnaire of how you feel. We're showing you the numbers in your situation is to, path A, if you want to take that path, here's your probability of success. Path B, this increases your probability of success. Once we have that plan in place, now here's how we have strategy that can help you navigate that in a manner that you can stay the course and be adaptive enough to take advantage of opportunity. And not a recommendation, Chris, but one thing that's a huge benefit to the distortions that the Fed has created in the U.S. markets is we've been the only game in town since January 1st, 2008. The only place that you had substantial returns. There are places around. I'm talking about broad indexes. So we have unusual opportunity in some of these international markets and some of these commodities. We don't know when they're going to take off. And if we do have a recession and don't get Goldilocks, yes, those prices can get even better, but that means your upside is even greater. So, I don't want people to think, oh, there's no opportunity out there. There's opportunity if you're willing to look and you're patient enough to move on it. There's a lot of opportunity around the world. It's just what has been the number one place to be for the past 10 years is essentially priced to perfection. And that's what everybody's chasing because there's nothing else to chase right now. But that's going to change at some point in the future. And the numbers are just astounding from the upside potential that you can have in the other way, in those other categories whenever they take off. We don't know when it'll be. I think we're as close to the bottom as you can get, but we'll never pick the bottom. But I do think we're close to it.
Well, thank you for that. It was a great explanation of all of that. And so for anybody listening, if you want to talk to Paul and his team, go to peakfinancialinvesting.com, fill out a very simple form. Paul and his team will get right back to you. Very happy to take you through a plan. And those plans, Paul, I've been getting just great feedback. People just love them. It's a breath of fresh air. And of course, everybody deserves to talk to a financial planner who speaks their language and has their best interests at heart. And of course, I know that's what you're bringing to the table. So thank you for doing that. Thanks for your time today. And we'll go shooting again sometime. That was fun too. We managed to.
Oh yes. Now I've got to say for the listeners that are out there, Chris Martinson is an expert marksman, and so is Evie. So the best way I can explain it, we got a chance to go shooting together with Chris and Evie and a couple of other individuals, and we're all shooting various guns, and I look over at Chris and I see him pull his target, and my jaw hits the floor. I'm like, it doesn't surprise me that he's that good, but he is that good, and he very casually and humbly, like Chris is. Y'all all know how humble Chris can be at times. He walks over and gives me a pointer about what he had learned, and I started shooting a better group. So the bottom line is, Chris, I don't care where I am. If I'm in a hostage situation and somebody's got a gun to my head, I want you there. Take the gun from the police officer or whoever's there. I want you to be the one pulling the trigger to get me out of it, because I know, and Evie too. So the way you two shot was impressive.
Well, thanks. No, I mean we've put in our time to get there, and I'm going to correct you on one thing. It's not pulling the trigger; it's squeezing the trigger.
Thank you. That's another tip that I need to learn. Yes. I'm just going to sit next time I go to the range with you with a pen and a piece of paper and watch. I think I'll record you so I can learn what you do. That's what I used to do in skins. I'd record somebody really good and watch it over and over and over and over and over.
Yeah, no.
So I was impressed. Kudos to you. You're one of the best marksmen that I've ever had the opportunity to shoot with, and I've shot with a decent number of people.
Yeah, no, I do enjoy it. It's a great sport. So, yeah, thanks for that. And maybe, I'll post a picture. Maybe we'll weave a picture in of Evie's group. Her first group, we hadn't shot in a couple of years because COVID and stuff like that. But, man, she really squeezed out a tight group there on that her first magazine, Very nice. So, yeah.
She did. I went from you to look at her, and I was like, "God dang, she's just as good as you are, nearly as good." I mean, her groups were great, so that I think that would be good to share. It was
That's
impressive.
all right. We'll go fly fishing, and I'll be slapping the water in front and behind me, and you'll catching trees and bushes. It'll be great, So we'll do that too. But hey, I really enjoyed that. That was a lot of fun, and such a nice range out there in Scottsdale. It was really, I would join that. I mean, it was such a pro setup. Really enjoyed it.
Yes.
Really did.
Yes.
All right. Well, with that, Paul, thanks for your time again, and we'll do this again next week. And I hope everybody enjoyed this edition of Finance University.
Thank you, Chris. Always an honor.
Hello, Chris Martinson. I'm the CEO of Peak Prosperity and also Peak Financial Investing. And after watching that, you're probably wondering, well, what do I do with my money? Look, you both deserve and need somebody who can talk to you about what's really going on in this world, understand the situation as it is, not be steering you towards certain things that don't make sense for you or just keep you in a game that's already ended. Look, if you want to talk to somebody about the petrodollar declining or what is happening with gold or which sectors are actually the best ones to be in, given what the Federal Reserve is up to or the federal government, you deserve to talk to somebody who can answer those and has a few gray hairs and has been there through some of the economic cycles because, hey, we're in another economic cycle, so it's good to have that experience. Fortunately, at Peak Financial Investing, what we do is we go out and we scour and we look for the very best firms out there who satisfy one thing above all else. They've got great experience coupled to great customer service. So if you want to come by peakfinancialinvesting.com, there's a very simple form you can fill out, just a few fields. You hit send. What happens is an email gets triggered out. It goes to an endorsed firm of ours. You will get an email back. You can then set up a phone call for a 30 to 45 minute free, no obligation, no pressure call to find out if this firm is a good fit for you and to find out if you're a good fit for the firm. It has to go both ways. And if all that matches up, this will be one of the best things that could happen to you this year. So please come by peakfinancialinvesting.com. Very simple process. We would love to help you if we can. Thanks very much.